Most Americans believe they understand taxes. They think taxes are simple: income tax, sales tax, property tax, numbers printed clearly on paychecks, percentages written on receipts. But what if I told you the biggest tax Americans pay is never written anywhere? No form, no bill, no warning. And yet, it silently takes more money from you than most official taxes combined. This is the story of the invisible tax. And once you see it, you'll realize you've been paying it your entire life without ever agreeing to it. Welcome to the system. America wasn't always like this. There was a time when saving money actually made sense. $1 today was $1 tomorrow, sometimes even more. In the 1950s and 60s, an average American family could save and watch their purchasing power grow. Banks rewarded patience. Money sitting still didn't shrink. Then something changed. Not overnight. Not with headlines, not with protests. It changed quietly. In 1971, the United States made a decision that most Americans never truly understood. President Nixon closed the gold window. From that moment on, the dollar was no longer backed by gold. It was backed by trust, and trust is fragile. This decision unlocked something powerful and dangerous. The government gained the ability to create money without creating value. At first, nothing seemed wrong. Paychecks still arrived. Prices didn't explode immediately. But beneath the surface, the invisible tax was born. Inflation. Most people think inflation is just higher prices. That's wrong. Inflation is a transfer of wealth, from savers to spenders, from workers to debtors, from the public to the system, and it happens automatically. No vote, no consent. Let's make this painfully clear. If you saved $10,000 in 1971 and kept it in cash, today it would buy you less than $1,500 worth of goods. Where did the money go? It didn't disappear. It was taken, slowly, silently, legally. That loss is the invisible tax. Every year, inflation reduces your purchasing power, even at low levels. 2% inflation sounds harmless, but over time, it destroys savings. At 2%, your money loses half its value in about 35 years. At 5%, it happens in 14 years. At 8%, it happens in 9. No IRS letter required. Now ask yourself this: who benefits? Because someone always benefits. Debtors benefit, governments benefit, institutions holding assets benefit. The middle class does not. The poor feel it first. The middle class feels it longest. Wages rise slowly, prices rise fast, and the gap widens. Look at housing. Have you ever felt like you're running on a treadmill, working harder and harder but never getting ahead? You might be paying a tax you don't even know exists. It's the invisible tax of inflation, and once you see it, you can't unsee it. You notice it in the grocery store, at the gas pump, on your rent statement, and in your medical bills. It doesn't send you a notification. It doesn't ask for permission. It just takes, quietly, relentlessly, and the most dangerous part. We're trained to believe this is normal. We're taught to blame ourselves. If prices go up, you need to budget better. If your savings are shrinking, you need to work harder. If retirement feels out of reach, you just need to sacrifice more. But what if you're not failing? What if the measuring stick itself is shrinking? Let's talk about the dollar. $1 today isn't the same dollar your parents earned, and it's definitely not the one your grandparents trusted. The US dollar is no longer a stable store of value. It's a policy tool. And with any policy, there are winners and there are losers. Since the early 1970s, the purchasing power of the dollar has been in a slow-motion collapse. It didn't happen overnight, which is why nobody panicked. Milk didn't double in price in a day. Rent didn't triple in a year. Instead, it was a slow, creeping change. Year after year, bad decision after bad decision, Americans just adjusted their expectations downward. This is how the invisible tax works. It doesn't start riots, it creates resignation. People stop asking why things are getting more expensive and just start adapting. Two incomes become the norm. Side hustles replace job security. Debt replaces savings. Now, let's look at the financial system from a bird's eye view. When inflation kicks in, who wins first? Banks make more on interest. Big corporations can raise their prices instantly. People who own assets, like real estate or stocks, see their net worth go up. And who loses first? People who earn a wage, retirees on a fixed income, anyone holding cash. Inflation is not a neutral force, it's a wealth transfer. The middle class gets hit the hardest. They're too well off to qualify for government help, but too dependent on their paychecks to be protected. They do everything they're told. They save responsibly, avoid risky investments, and trust the system. And for that, inflation punishes them. This is exactly why we see wealth inequality skyrocket during inflationary times. Assets inflate much faster than labor. Your house appreciates while your salary stagnates. The stock market soars while your wages barely crawl up. Ownership compounds. Employment decays. Think about this. When the Federal Reserve creates new money, it's not handed out equally to everyone. This new money enters the economy through specific channels, like government spending and bank lending. By the time that money trickles down to the average person, prices have already gone up. That's why those stimulus checks never made anyone rich. They were a temporary patch, arriving long after inflation had already done its damage. This system doesn't need some grand conspiracy to function. It just runs on incentives. Our entire economy is based on debt, and debt-based economies need inflation to survive. Without it, debts become impossible to pay back. With it, debt quietly dissolves over time through the loss of purchasing power. Governments don't default on their debt publicly. They do it privately, by devaluing the currency. Look at the national debt, trillions of dollars. It's unpayable by design. Inflation is the only politically acceptable way out. This changes how we live. Saving money becomes irrational because your cash is a guaranteed loss. Spending becomes logical. Speculation becomes a means of survival. People are pushed into financial markets they don't understand, not to get rich, but just to keep from getting poorer. Investing is no longer optional, it's mandatory. And here's the final piece that almost no one talks about. Inflation is psychological. It destroys trust. It makes long-term planning feel pointless. It erodes the belief in delayed gratification and stability. Everything becomes about the short term. Consume now, borrow now, enjoy now, because tomorrow, it will all cost more. This is why financial anxiety is at an all-time high. Even when the economy is supposedly growing, people feel it. They feel that invisible tax draining their future. The brutal conclusion is this: the invisible tax is not an accident. It's not temporary. It is a fundamental feature of how modern economies work. The only real choice you have is how close you stand to where the money is created. The closer you are, the more protected you are. The farther away, the more you pay. Once you truly understand this, you stop asking how to beat inflation. You start asking how to position yourself around it. And that single shift in perspective changes everything. Thanks for watching.